Hello and welcome to the market update for April 2015. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals. I have 17 years of experience in the financial services industry, a current licensed securities and derivatives advisor. The format for today's presentation, it's a very quick look at the macro update this month. We roll through the top 50 stocks with a focus on the 2015 earnings. But the real centrepiece of today's recording is to actually look at some technical trends that are taking place within the top 50 stocks and try to marry those comments up with the underlying fundamentals. We tie that in with the portfolio allocations and the short-term market outlook. If you'd like to know more about the Investor Signals service, we provide a model portfolio of ASX 50 stocks. We utilise the benefit of call options to enhance portfolio returns. We focus on effective ownership around ex-dividend dates, generating above average cash flow, capital growth, all managed under a strict investment mandate, therefore suitable for self-managed super funds, and the assets remain in your name. Please contact me on the details on screen there if you'd like to discuss with me opening the Investor Signals broking account. Moving straight in today to a graph of the US market and starting with the Dow Jones. Now, the outlook for US earnings, I think, has started to moderate a little, and that's probably driven by a couple of things: the ongoing weakness in Europe and China, the high US dollar. So as we now get through the March quarter, we'll expect to start seeing the earnings results come out in the weeks ahead. On an annualized basis, the market was looking for somewhere around 8 to maybe 10% earnings growth over the next 12 months. I think that's probably moderating. I think the market will accept somewhere around 5 to possibly 5 to sort of 8% as a range where we expect on average S&P 500 earnings to sit over the course of the March quarter, and probably the outlook for the next 6 months, although probably investors would expect to see a slight pickup in US earnings off the back of the US moving out of a cold winter into a warmer summer. So the housing sector, retail spending, those type of things, there'd be an anticipation that those numbers slightly improve. So that's probably a story more for after the June half to see whether those US earnings are probably a little bit stronger in that June quarter than what they are in the March quarter. But I think really what this means for the US indices, and I've spoken about this in detail in last month's recording, is that I think the markets are likely to remain relatively flat, and that still provides a suitable opportunity for stocks within the ASX for us to pick off value and sell covered calls. The yellow box on screen there indicates where I see the US equity market spending the bulk of its time over the course of the months ahead. Just also to touch on this US 10-year Treasury, again, I spent a bit of time on this in last month's recording, but just to revisit it, we've seen as the anticipation there that US interest rates were likely to rise. In most cases, I guess the consensus was around June. We've now seen that push back, and we're probably likely to see at earliest an interest rate rise in September, and the bond market's really supporting that. We've seen the yields pull back from 2.2 back down to around 1.8. If we are to believe that ultimately the US economy is strong enough for rates to begin rising, that trend line there will ultimately need to be taken out, and we'll see these yields establish a higher low, and that's really something that we just keep an eye on over the next 6 months or so to see whether the bond market is supporting commentary in the media around US rates increasing, and that obviously then has implications for the Aussie dollar and asset allocations within the top 50 stocks with regards to companies that have high offshore earnings. On that note, let's move straight into the XJO. So with our market, it's sitting at the top end of where I think full value is, so I think we're probably likely to bump up against this level here at the moment. The Australian banks are reasonably full value at these levels, so in order for the index to really push higher, when you consider industrials are trading at historically high PEs, up around 19 times earnings, underlying earnings growth for industrials has been probably one of the stronger parts of the market, running around 8%, but really the missing ingredient in order for the indice to really kick on is obviously the resource stocks. We're starting to see greater measures from the PBOC in China there to stimulate, in particular, the property market. But I think at best all that does is put a floor under things. I don't think we're going to see any great short-term recovery in China. So I think the story for Australian commodities really, unless we see global GDP pick up to sort of a 3.5% range, the commodities are probably, again, at best just going to bump along sideways. So on an index level, I think our market's likely to run into resistance, and we may get a rally sort of in June, July, if we start to see better economic data out of Europe. But I think over the months ahead, we're likely to predominantly move sideways. Okay, first of the top 50 companies that we're going to have a look at is AGL. This is a name that there it is up on screen there. This is a name that we've been holding in portfolios for a while. We've sort of largely sold covered calls a number of times. We've been recent buyers of it for new money that's been freed up in portfolios. At $5.12 where it's trading at the moment, though, I think the stock's full value on next year's earnings, which is FY 16 earnings, allowing for growth of around about 8%, which I think is probably at the top end of the range. The company trades on a 4.5% dividend yield, so I think it's now time to sell covered calls. Somewhere up around 15.50, I think, is the ideal level to get the calls away there on AGL. Asiana, not a lot in the way of top-line growth. The company's still being very disciplined on costs. On next year's earnings, the stock's on a 4% dividend yield. That allows for the company increasing their payout ratio a little. 14 times earnings. Again, I think it's reasonably expensive up here. Unless we saw Asiano pull back to around $6, then I'm happy to take a look at it. And you can see I've sort of marked that level out on screen there. Amcor, still one of our favoured names, but put it in perspective, the stock trades about 19 times next year's earnings. It's trading on a 3.8% dividend yield, and the company should deliver, maybe somewhere in the order of around 7% in earnings growth. So if an opportunity to buy into Amcor again anywhere around $14, I don't think you're taking on board too much risk. So the strategy being there that happy to own it again at $14, probably go out into the back half of the year and sell covered calls up at around $15, $14.75 thereabouts, collect the August dividend, collect that call premium and allow for a little bit of capital growth. I don't think even in a volatile market Amcor creates too much risk to a portfolio. So still comfortable sort of keeping an interest there in that name. AMP, starting to sort of come back onto the radar. The company's delivering reasonably consistent earnings growth of around 8 to 10%. The stock trades on a forward yield into 2016 of around 4.7%. But there's other names that we're preferring to allocate towards, but certainly AMP starts to look more interesting now that they've sort of got about 18 months of pretty consistent earnings growth under their belt. ANZ, within the banking space, I think they're all pretty much trading on similar multiples, and I think they're sort of within 5% of really where they start to run into some resistance and probably struggle to push too much higher. But just to give you some numbers there on ANZ, based on next year's earnings, very modest earnings uptick of around 3%. The stock trades on it, just over 5% dividend yield and about 13 times earnings. APA not doing it there at the moment. ASX, this stock's pulled back a little, and we've been waiting for this. So we have been owning it over the past really few years, and we've been selling the covered calls up around this $39 level, and it's successfully added some good returns to the portfolio. And now we've had ASX breakout, and in last month's recording I gave some reasons for that breakout. We were looking for it to pull back to around sort of $40 thereabouts, and we're willing to take another look at it. So I think we keep this on the radar, and even sort of here at around sort of $41, I think maybe there's an argument that it could be worth adding this back into portfolios, and it's really a combination again of the defensive nature of the business and the prospect of corporate action. So when you put some numbers on it, the stock was trading on a div yield of around 5.5%, and now we've seen that compressed down to around 4.5%. The company will grow earnings at about 5%, so it's not a strong growth business, but again, I think coupled with the prospect that there could be takeover action in the next 12 to 18 months, that's probably a reasonably defensive way to drive returns out of the market at the moment. So liking ASX on this pullback. AZJ, again, not much in the way of earnings growth, very disciplined on the cost control. On FY 16 earnings, the stock trades about 16 times earnings on a 4.5% dividend yield. We're a buyer of it at $4.50. We're a seller up at around $5, selling the $5.25 calls. Don't see the stock pushing too much above that. BHP, in last month's recording, I highlighted the negative technical pattern here that we've seen the stock break lower, a lower high come in here. It sold off, it rallied back, filled in the gap, and then it sold off again. I think BHP struggles, it bounces sideways, and that sort of fits in with our view that we think the commodity market really bumps along sort of the bottom of these levels that it's sitting at the moment. BHP's got the upcoming spin-off of South 32. We'll probably expect to see more confirmation or finalisation of that around May, June at the latest. So that could unlock some value for shareholders, and for that reason it's worth being a little bit patient there. Brambles, top end of valuation range, and here's where the industrials start to look expensive. Brambles trades at around 20 times FY 16 earnings on a 3.3% dividend yield. Yes, you get the benefits of a higher US dollar or a strong US dollar, converting back to a weaker Australian dollar, enhancing underlying earnings returns, but at 20 times earnings on a 3.3% dividend yield, I think it's a great company. There's exposure there to a recovering Europe. Any pullback to around sort of 10.50 would be aggressive buyers of Brambles, but I think the argument here is if we are owning it, we need to be pretty aggressive. We're selling the covered calls. I don't see much in the way of capital growth there. CBA, just to give you some yield numbers on this, again, all the underlying earnings growths within the banks are around the same, but the stock trades on about 4.5% dividend yield, so certainly compressing down. Again, I think given that we don't sort of see that huge tailwind from stronger US indices driving money into the Australian equity market in the months ahead, I think CBA largely bumps sideways at or near this current level. Coca-Cola getting a little bit expensive. It's enjoyed a good rally off the back of the optimism around the earnings downgrades ending. I think management was pretty clear that at a 5% earnings growth in the next half would be a good outcome. When you factor in those numbers, the stock's trading 19 times earnings on a 4.3% dividend yield. I don't think it supports a valuation compression beyond that. So looking for a retracement in Coca-Cola, probably back down to where fair value sits is probably closer to $10 than it is $11. So looking for that correction to occur. Computer share, again, a little bit expensive, trading up at one stage there, pushing up to around sort of 17, 18 times earnings on a 2.5% dividend yield or 2.8% dividend yield. I don't think it was justified. Looking for computer share to sit at around 12 to 12.50, and then we're probably happy to take a look at adding that to portfolios. CSL, underlying earnings growth of about 8%. The company's still conducting their share buyback. Obviously, there's strong US dollar earnings within the CSL income stream, which helps on a currency conversion basis, but the stock is expensive up here. To the extent that we own it, we're being aggressive and selling the covered calls over it. Crown, here's one that's just worth sort of adding onto the watch list. So we've had Crown break out, create a higher high. It's pulled back now. It's created a higher low at around $13.50. I think the stock's maybe got the capacity to trade back up to around $15. I think it runs into resistance there, but I've got the stock trading 15 times earnings on around a 3% dividend yield. Dexus, just to highlight this again, it fits into this pattern of a higher low formation occurring. I think maybe at around this $7.50 level the stock starts to look okay value and should find support. Fortescue, not doing here. I think the pressure's definitely to the downside, and there's no reason to believe that's going to end anytime soon. Goodman Group within the property trust name, great underlying business here, delivering growth of around 7 to 8%. However, trading on 3.8% dividend yield and almost 16 times earnings makes it expensive. So in the absence of another interest rate coming through from the RBA, I think these property names look pretty much full value, but I think comfortable owning them and selling covered calls. So to that point, GPT, there is calls over this at $4.50. Reasonably comfortable owning this stock, selling calls up at around $4.75, trying to lock in that upcoming dividend and that call option. IAG, so this is actually one of the names that we've allocated money to recently, so looking for maybe a push back up to 620, 650, then we look to sell the covered calls up at around 675. I think that caps any upside, but again locking in that call premium and the upcoming August dividend there on IAG. IPL, now we're seeing strong demand for DAP, and that's feeding through to stronger prices. They're a beneficiary of a lower Aussie dollar. Those factors I think have largely played out. The stock, for my money, is looking a little expensive up here on a 3% dividend yield, 16 times earnings, waiting for a pullback maybe at around $3.50. Very keen to jump back into IPL again. James Hardie, we're seeing stronger numbers here. Underlying earnings are up around 20% on the same time last year. Good top-line revenue growth. The stock's really performed well off this sort of $11 support line, and I think that trend's probably likely to continue. So continue to stay focused on James Hardie as an addition to portfolios. Lendlease, this is a name we like. It is expensive. Trades on a less than a 4% dividend yield, roughly 13, 14 times earnings. The strategy really is we have been buyers of it on this recent pullback, but at around 17.25, 17.50, I think you really need to be looking at selling covered calls up at around 17.75. I just don't see it's got the potential to push too much above that, and it's likely to consolidate, move sideways in line with our broader view for the market. Mirvac Group, as with all these property names, the recent pullback that they've had, I think makes them interesting, and at or near this level of around $2, Mirvac looks pretty good value. So we've seen Medibank Private added to the ASX Top 50 index now, and this is a name that we hold in portfolios. We've been buyers of it on the assumption that the company was likely to outperform the prospectus forecasts, and we've seen that happen. On an initial analysis, their first half 15 normalised net profit came in at around $141 million, which looks to be about 6% ahead of the prospectus. So it still puts the stock on a reasonably expensive yield, and on an annualised basis with a yield likely to be trading somewhere around 3.5%. But the idea here is that we own it at these levels. We're looking for a rally back up to around $2.50, and then we look to sell the covered calls out into December, collect the upcoming August dividend, and I think the range for Medibank Private over the next 6 months really is probably from $2.40 to maybe $2.60. Don't see it doing too much outside of that, but again, it's a defensive name to deliver returns out of the market without sort of being exposed to too much volatility. Macquarie, we're not doing it there at present. Our preference is still with the major Australian banks, so those being NAB, Westpac and CBO. So in the case of NAB up on screen there, just to put some numbers on this, the stock trades at around 5.5% dividend yield, about 13 times earnings, and again at around $40. Maybe there's 5% upside, but I really think you have to start considering trimming some of these recent gains, keeping exposure to maybe 50% of sort of the original position in the banks, but just starting to sort of build a little bit more cash in portfolios, which is largely what we've been doing across, say, the last 3 weeks or so, and it's only now that we start to sort of look around and pick off some opportunities where we start to see these structural trends supporting what's likely to be higher movement in the share prices. And here's a great example of that on screen with Newcrest. So we've actually got a higher high and a higher low formation occurring here, and we're starting to see Newcrest break out a little. I think it's got the potential to trade back up to around probably as high as sort of $17 over the course of the remainder of the year, and that's maybe even in the face of a slightly higher or stronger US dollar. And Origin on screen. So Origin, look, there was a lot of speculation that investors were likely to see increased dividend payouts from Origin. I think that's been pushed back, obviously, as a result of the lower oil prices and gas prices. And I think Origin's necessity to manage their debt or pay down their their debt levels. So I think when you look at Origin from a yield perspective, the stock trades on about a 4.5% dividend yield and about 15 times earnings. I really think we're in an environment where Origin's fair value is at around this sort of $11.50, $12. So it does require selling a covered call over it at around sort of $13, $12.50, $13, I think, to complement the returns. I don't see too much capital growth short term there in Origin. I reckon just to highlight that structurally there's some pressure here to the downside, and we'll keep an eye and revisit this in next month's recording, but it certainly looks to me like Orica's probably likely to want to trade lower. Oil Search, Santos, all struggling off the back of sort of an oil price that seems to recover for 3 or 4 days and then it gets sold off again. So it's very hard to tell sort of when that bottom eventually occurs in crude prices. But in the case of Oil Search, again, the expectations of higher dividends flowing through to shareholders over the next year or two diminishes off the back of this lower oil price. I think on fair earnings growth forecasts into 2016, the stock's probably likely to deliver a yield of around 2.5%. So interesting, but probably there's better opportunities elsewhere in the market. QBE, this is one of those names that comes onto the radar. We've seen the company raise around $850 million, help strengthen their balance sheet. We've seen the insurance margins improve for the first time for a number of years. The stock's breaking higher in a higher low pattern at around sort of this 12.50 to 13.50. I think there's a fairly strong argument to say that it's worth keeping QBE on the watch list. Ramsay Healthcare, great company, growing earnings at about somewhere in the order of around 10 to 15%. I think the issue here, probably even higher, around 15 to 18%, I should say. The issue here is the stock trades at 28 times earnings on a 1.8% dividend yield. I think it's ready for a consolidation and a move sideways. Rio should be well supported by the capital return or the share buyback that the company's conducting. Iron ore prices really are struggling to sort of move higher from sort of this $50 range, allowing for earnings growth maybe at the most, and this is predominantly coming through a reduction in their capital expenditure program, but allowing for earnings growth somewhere around 5% over the next 12 months will put Rio on around a 5% dividend yield and about 11 times earnings. So I think Woodside Petroleum, BHP and Rio are starting to look interesting from a valuation perspective, but it is difficult to sort of identify, the bottom in, what's largely been a falling share price. Scentre Group, some valuations here. The stock trades at around a 5.5% dividend yield. If we were to see it pull back at around $3.60, probably happy to take a look at it, but otherwise our preference remains sort of GPT and possibly Stocklands as the two that we're sort of gravitating towards after this recent pullback that we've had in the market. Seek, another name that's been added to the top 50 index. I think it's reasonable value here at around $16, $17, and we start to put this one onto the radar as well, and we start to look to allocate capital towards Seek as we have with Medibank Private. So both of those new names that have been added to the index are on the radar there. Stocklands, it's pulled back from almost $4.90 back to around $4.50. To put some valuation numbers on Stocklands, the company trades on a 5.5% dividend yield, 16 times earnings. It's likely to grow earnings at around 8%. So those numbers allow for that upcoming earnings growth. I think the stock's likely to put in a support level here at around $4.50, and if we're reallocating capital into Stockland, we're also selling the covered call out to December there to complement that return, which a combination of the dividend and that call premium, we're driving up to around 10% cash flow out of some of these relatively defensive names that we've seen a little pullback in the share price, and I think that's presenting an opportunity to maybe jump back into some of these names. In the case of Sonic Health, we like this business. We've been owners of it throughout the last sort of 12, 18 months. But again, to put some numbers on this, the stock trades at about almost 19 times next year's earnings on less than a 4% dividend yield. To buy back into Sonic, I really want to see it pull back to around $18.75, $19 thereabouts, and we'll be very keen buyers of Sonic again at those levels. Suncorp, this is a name that we've been adding to portfolios, so we've started to sort of creep back into the domestic insurance business in Suncorp and IAG. The stock trades on about a 6.5% dividend yield, about 12 times earnings. We've been aggressive with the covered calls up here to around $15, so we've collected the recent dividend. Those covered calls go out to December, so we'll either end up being called on the stock ahead of the August dividend, which will be fine. It will mean we deliver a good capital gain as well as the income from the dividend and the call option. If on the other hand we get through the August dividend, we'll collect that, and our resistance level for Suncorp's up at around 15.25, so that sort of fits in with where we've sold that covered call. I should say around 14.25, and that sort of fits in with where we've sold that covered call level. Sydney, not to think they're at present at the moment. Transurban, continue to like this business, just certainly getting expensive, yields compressing down to around 4.5%, but we're continuing to see sort of capital rotate out of the names that have gone ex-dividend, and you've got the likes of Transurban, GPT, Stockland that will pay their distributions in that June quarter, and we're probably likely to see those names stay reasonably strong in the lead up to that June dividend. And that's something to think about again from a capital allocation perspective. How can we own those names, sell the tight covered calls, get the dividend, and have sort of some downside protection if volatility was to pick up, because they're the names that capital's probably going to stay exposed to. In the case of Telstra, we've seen the underlying half-annual dividend jump up a little to 15 cents. It's on an annualised basis up to around 30 cents. That puts the stock on about a 5% dividend yield, about 17 times earnings, and we've seen moderate revenue growth. Certainly the mobile area of the divisions of the business is delivering good growth, but interesting that the stock sort of lagged and underperformed post the February dividend. I think that's a trend that we've probably seen before, and we'd expect to see coming into August. Telstra slightly improve. Any range between sort of $6 and $6.25, $6.30, I think is a compelling story to jump back into Telstra, ride it up into the August dividend, and then sell the covered calls over it. Westpac, I think I've covered my commentary on the banks, but Westpac's around 5% yield, and looking for earnings growth again somewhere around 3 to 5% in the 12 months ahead. Wesfarmers, interesting. This has underperformed, even though the company delivered almost 9-10% earnings growth. Strong performance from Coles and and Bunnings. I think the issue here is increasing concern around price competition, and we've seen Woolworths deliver earnings growth only at sort of that lower end of the scale, around 1 to 2%, and I think that's starting to impact on the way investors look at Wesfarmers. To put a number on Wesfarmers, the stock trades on a 5% dividend yield at about 18 times earnings. Anywhere back down at around $42, we'd be aggressive buyers of Wesfarmers, but it does require that covered call to complement the income. Westfield, now we're owners of this at lower levels, and we've taken profit up here at around, I think, $10.30 roughly. On a pullback back down to around this sort of $9.60 level, happy to jump back in. But again, at $10, the stock trades on a 4% dividend yield. It shouldn't compress any more than that, so I think it's destined to trade sideways. So it really is a story that you have to be buying it closer to that $9 range and selling it up around 10, and having a view that it's probably likely to bounce between that range a number of times over the next 6 months or so. Woolworths, as I'd mentioned a moment ago, the stock's only going to grow, the company's only going to grow earnings at around 2%. The stock trades on about a 4.8% dividend yield, about 15 times earnings. I think there could still be some risks around Woolworths over the course of the next 6 months, but again, if you were to take a 2 or 3 year outlook, I think we'll look back and realise that somewhere around this, whether it ends up being $25, $27, this will ultimately be a good level to be a buyer and a long-term holder of Woolworths. I think eventually the Masters Hardware strategy will work, and the market will start to sort of price that favourably. And then finally moving on to Woodside Petroleum. To put some numbers on the yield story here with Woodside, I think is probably the most important part. It's likely that the dividend distribution will probably come down from where market expectations are, and if the company distributes roughly $1.90 to $2 maximum of dividends, puts the stock on about a 5.5% yield, trading about 14 times earnings. So in line with the other resource names, I think we're probably heading into a period where it consolidates and moves sideways. And my view here on Woodside really is maybe at around $33 it's good buying, and up at around $37 it's expensive. And to the extent sort of, with BHP, Rio, Woodside, you form a view that, there's maybe somewhere between, say, 10 to 15% in the trading band, and we're probably likely to have a 6 to 9 month period where they largely sort of move sideways and bounce between that support and resistance level. And then finally, to conclude today's recording, back to the top 50 index. So just to summarise where we see things, simply because valuations are stretched, yields have compressed, and US earnings are not likely to really grow. And the only caveat to that is if we see growth substantially pick up in Europe. I don't think there's the evidence that that's occurring. I don't think there's the evidence that China's really rebounding. The higher US dollar, it's hard to build a case that US earnings grow above market expectations, which are at the moment are priced in at around sort of 7 to 8%. I think probably, if anything, there's an increasing chance that the March numbers disappoint a little, and I think there's probably a chance that the June numbers throughout summer start to improve a little. On balance, I think we're in for a period of consolidation, and therefore it requires owning the defensive names but selling tight covered calls over them, collecting the dividend, collecting the call premium. And if you'd like to know more about how Investor Signals can help you to manage your portfolio and work in partnership with you, please give me a call using the details on screen. Thank you, and look forward to speaking again next month.